All right, we're pressing the right button. We are on our way. Good afternoon, investors, and welcome to our March 18th, 2025 edition of Bull Sessions. My name is Mark Robertson, and I am joined here by my dear magical mathematician from a few miles to the north, Ken Kavula. Good afternoon,
Hi,
Ken.
everybody. Good afternoon, folks. Good afternoon, Mark. I'm raring to go today, so let's get this car on the road here.
Yeah, we have a whole lot of stuff to cover, but I will share that we're going to describe an investment club visit we made to, theoretically, Cozumel, Mexico, but as it turned out, they weren't there anymore. So that's Ken and me lost in the desert, attempting
Well,
to
folks,
return to the north.
that's the story Mark enticed me with to get me to go to the meeting. Okay, that it was going to be a Mexican club. Okay.
Yeah,
Well, did you at least get a margarita?
I did afterwards for sure. So good stuff. Well, and we're also joined here by, you just heard the voice, Kim Butcher. Good afternoon, Kim.
Hi, everybody. Hope you're doing well.
Everything treating you well down there? I don't hear as much construction in the background, so.
You just jinxed us.
Let's
see, they have been working on both passenger elevators, so we have to use the service elevator, and then they're polishing the marble in the lobby. So, yeah, let's just say I've been hibernating in the condo, or I get out of the condo for 6 or 8 hours all day.
Absolutely. We're also joined here by Houston's Matt Spielman. Matt, by the way, there's a chance that the Fighting Illini could face off with Houston here in a couple rounds.
Yeah,
it's a small chance.
I'll have to say that that's a tough ticket to get. I wanted to take my son to see Houston, and they sell out quick.
Yeah,
so I have to get my Indiana hat on and really think about basketball that way to make sure try and get in on there.
Absolutely. Yep. So it is March Madness. This was a little bit of madness here today. We will talk about the time we spent with the club. They weren't actually in Cozumel. They're actually distributed widely across the country, and we'll talk about them. Kim and her colleague Bakul actually wanted to promote a discussion on activist prospecting. So we'll take a look at that, and we do have a brief challenge to Costco that we'll touch on. So let's go ahead and get underway, Ken, because we have 42 pounds to put in this 10-pound bag here today. Here's a Portillo's moment. Portillo is not a sponsor of this session, although they should be. The stock price has recovered nicely in the last couple of days. And yes, that is the Chicago River on the upper left. And that looks dramatically like the hot dog that Ken consumed a few months ago.
Okay, well, that's 2 pounds. Let's move on, okay?
And I believe that is a new Houston location, thanks to Ann Manning. Matt, is that correct? Willowbrook, Texas?
Yeah, Willowbrook is about half a mile away from where my wife grew up. So, yeah, that's just one of the new locations.
One of two, right? Yeah, cool.
Yep.
So thank you, Ann Manning, for checking in with us. And Kim, she would like us both to know that she's supporting our stock price. So good stuff.
We appreciate it.
All right, here is our quick disclaimer. No investment recommendation is intended. This is purely intended to be the sharing of the ideas promulgated by the Modern Investment Club movement, from the discovery of opportunities to the analysis of those opportunities and deployment in portfolios, which more often than not turn out to be pretty successful. There are no guarantees in this business, but boy, watching what people have been doing for nearly 8 decades and learning from that and attempting to share that is what this is about. If we own something that we're talking about, we'll try to remember to disclose that. Make your own decisions about all this stuff. Do your own homework. If you have any suggestions or requests, including copies of the slides or questions, our 2 email addresses are at the bottom of the page. Anything, Ken?
Absolutely. Let's keep on moving here. I'm answering a question here, so I'll get that answer out to Phil real quick.
All right, we're $1 late and a day short of St. Patrick's Day, but just wanted to get out that Irish blessing to everybody out there. And that is the Chicago River being dyed green once again this year. But this week's update batch does include companies like Apple and NVIDIA and it's quite a green batch. All right, here's a quick look at our stock market characterization by the value line arithmetic average. That's what the green bars represent. You can see that the first quarter of 2025 has been a bit rough.
Mark, we need to fix a problem. It does seem that we're not getting our message out there. They're not hearing us.
Oh.
Maybe you can ask some people to confirm.
I'm still.
We're getting.
Yes, we have not started broadcast.
We're getting a lot of folks. Did you start the broadcast?
The broadcast is now starting. All attendees are in listen-only mode.
Does that mean we have to back up?
You got to start out. You got to go back to Portillo's quickly, Mark. You got a 7-minute penalty. Okay.
Oh, good grief, people. No, I didn't realize I was the one starting the broadcast, I guess. I did hit the right button. All right, so real quickly, welcome everybody to the March 18th, 2025 session of Bull Sessions. My name is Mark Robertson. I am joined here by my dear friends and colleagues, Ken Kavula, Kim Butcher, and Matt Spielman. And you'll hear more about us being lost in Mexico here in a few minutes. Anything else there, Ken?
Nothing else to talk about. Folks, if you're hearing us, could I have just a couple of folks that told us they weren't hearing before now tell us that they are hearing? Don't everybody tell me you are hearing, but just a couple of folks that told me you weren't. Okay?
Just a couple of hands up, and while we're doing that, this is our weekly reminder that Portillo's is not a sponsor of this session, although they should be. That is the Chicago River on the upper left, and that does look an awful lot like the hot dog that Ken enjoyed a few months ago. And Ann Manning is joining us there at the bottom center of the screen, celebrating the most recent edition of a Portillo's near Houston. All right, standard disclaimer for everybody, no investment recommendation is intended. If you're new here, we're basically sharing the lessons that we have observed and learned from the modern investment club movement, from the discovery of opportunities to the analysis of said opportunities, and basically sharing the success that we've seen people enjoy with their portfolios over many years. Please do your own homework, and if you have any comments or suggestions, the 2 email addresses at the bottom of the page will work for you. So with that, happy St. Patrick's Day, everybody. This week's batch does include Apple and NVIDIA, and that is the Chicago River being dyed green one more time. So we're one day late on St. Patrick's Day, but we're hanging on to it. So that gets us caught up, I think, Ken.
And things are going pretty well with the sound right now, Mark, okay?
Okay. One of these days, we're going to figure out the go-to meeting sacred chant to avoid those type of situations. I mean, we've only done this 200 times, so we think we would probably get it right. All right, here's our characterization of the market as represented by the value line arithmetic average. That's as if you took all the companies in the value line investment survey and added them up and came up with an index. That's what the bars represent. They are quarterly bars, and you can see how cruel the month of February was to us, and it has continued into March a little bit, and that light green bar on the right has slumped down a little bit. The return forecasts have actually bubbled up a bit, and we're still looking at return forecasts in that 10 or 11% range in general. And Ken, there's the answer to your question. You asked
I would have guessed a little bit less than that. So thank you for that data, Mark. I appreciate it.
All right, so let's go ahead and keep rolling. Like I said, we've got 42 pounds of stuff to put into an 8-pound bag, 10-pound bag, something like that. This was a question that came up after we had made a comment about those two numbers on the preceding page. MIPAR moving more rapidly, being more responsive to changes in the market than projected return on value or prove. And we just wanted to basically air out the question and make the point that, what it comes down to is current stock prices moving around, have considerable volatility. And there are the two calculations, and I think you can see that, a change in that simple formula at the bottom is going to be fairly big compared to the one in the middle. The current stock price is embedded in that denominator, so it's kind of a buffer. So it's going to be a little bit slower to react. Ken, how would you characterize the?
Well, if you're trying to explain it to a friend, I would just say that the proof calculation has a lot of numbers that are quarterly at best, and that only change quarterly. Whereas the MyPar numbers have only it's made up of only two values, and one of them changes daily, and one of them might change close to daily. So. I think MyPar is going to be more responsive to what the market is actually doing. I used the analogy before when Mark and I were talking about this. I used the analogy that you could think of MyPar as being right now, and you can think of Prove as being a measure of what might have been going on in the last quarter or so. They're both good numbers. They're both things that we use a lot and we think are important, but they measure different things, and they don't move in tandem.
Absolutely. Think horizon versus snapshot in some cases. All right, so let's go ahead and take care of the groundhog. Here is we have had a much better week. I mean, we were down an average of 11.2% for the average groundhog. That is now up at minus 7.9. So we had a pretty strong week amongst the groundhog field. So this is good. This is refreshing. We still have 40% beating the market. The average stock right now to keep things in context, is down 6.5%. Don't forget that. And I think everybody here except one of us is beating the monkey. And I do not enjoy being sub-monkey.
I wanna congratulate Matt. He's the first one of our regulars here to move back into the top 40. So Matt, we're gonna try to follow you back into the top 40 right here. And I have to mention,
you know why that is.
Well, I certainly do. And since I own that stock, I'm not sad about that for a change. Okay.
Well, when we set that free from Buttonwood, we knew that we would ignite that stock price.
Well, that's the rule. You sell it and it goes up, isn't it?
Or you buy it and it goes down. That's the other rule.
That's the other part of the rule, right? The reverse. I want to acknowledge the two Wolves Investment Club members that are on the top 40 list. Don, you're up at number 2, and I know I'll hear about it in a week. And to add insult to injury, my grandson has made the top 40 again. So he's nicer about it than Don is, but you know.
And our defending champion made it back to number 40 also. So it's still early. We try not to get too giddy about it, but I will point out that the club we're about to talk about is in 13th, and they've been near the top of the standings for the last couple of years, and they have members all sprinkled throughout here. So it was a really fascinating club to spend some time with. There's a couple more just off the list. So good stuff. Here's the context for today, and I think, newsflash, I think Y-Charts may have figured out what was wrong with their total return pricing for historical prices, because I have been gnawing my teeth off over the last few weeks while they were figuring out what was wrong. So let's hope that they have fixed that. But you can see that a couple of things. Buttonwood, we've been bragging about how steadfast Buttonwood has been here over the last several weeks. And sure enough, it has popped right up to a positive relative return. So let's hope that trend continues. And you guys all know the drill. The 10 stock names that are listed here are the most widely followed by our subscribers, and they've got a decent result to go along with it.
I think it's so important, Mark, in markets like this that we've been looking at the last week and a half or 2 weeks to remind folks that if you don't feel that you're doing real well, you need to compare yourself against a couple of benchmarks before you beat yourself up. And, you know, I don't like to see a 15-month portfolio that's basically flat, and that's what Buttonwood basically is for the last 15 months. But basically flat's a lot better than down 1%. And that's exactly what that relative return is telling us, that we are beating the market, we're staying ahead of the market. And if you can do that on a regular basis, then you don't have as many worries as you might have if you continually run down in those red relative return numbers.
Good stuff. So you can see that the Four Corners Investment Club, I've put them on here for context. They are very capable. They've been around for a little bit longer than is shown here, but they showed us their data that they are beating the market by approximately 4 percentage points over that time frame. They call themselves Four Corners because they have clubs very widely distributed across the country. They did have a Californian until they threw them out, and now they have Arizona. So, good stuff. Let's keep rolling. Here is the cover to our visit. Ken and I were convinced we were headed for Cozumel.
I apologize to anybody of Mexican heritage. I had nothing to do with this slide, okay?
Well, you know, I did get some comments that is that Ken's mullet simply going out of control or what? I can't explain anything about it. But we enjoyed the invitation. We obviously brought some Portillo's hot dogs along for the trip. A good time spent with a really engaging group. It was a virtual meeting. This is one of their slides. Again, we're not going to spend a lot of time on each of their club slides, but we went through the entire club portfolio with them. I found it interesting that they were being attentive, I think is a good word, Ken, to the size of the positions in their portfolio. Paying attention to core and non-core. They have several brand new and members and guests. And we talked about how, you know, perhaps giving a club member, a prospective, relatively new investor, a highly ranked core stock is a pretty good idea as opposed to a more challenging analysis with a non-core. What's your favorite aspect here, Ken?
Well, I just like the fact, Mark, that they're deciding what's important to their club, and then they're cataloging it and displaying it at their meetings to remind themselves of where they might be in a little bit of trouble and where they're doing real well. I especially like the years held. It's easy information for you to garner, but when you get an idea, when you see a really high number and then you look next to it, you see you've only held it for 1/10 of a year. Maybe it's not as high as you think. And when you get numbers in the mid-teens, maybe they're not as low as you think if you own them for 4 or 5 or 6 years. So it's good information all the way around, I think, and it keeps them focused on what they feel is very important. And it doesn't take a lot to maintain a spreadsheet like this for your club. I also like the fact that they believe, as my clubs believe, that once you own a stock, the SSG that belongs to that stock belongs to the club, and you don't just go in and willy-nilly change it whenever you feel like changing it, but you bring it to the club and ask them how you're going to change it and how it's going to look after the changes and everything else.
Yep, good stuff. And of course, that does boil down to, this was their question for us. What are the first 3 things to look at when inspecting a portfolio for the first time? So we obviously threw it. They use the dashboards at Manifest, so we threw it up on the screen, and this is what we start with. I'll start with the big green arrow. This is why we're here. We are attempting to design and maintain a portfolio which beats the market by 5 percentage points. And you can see that they're relatively close. On the night of the meeting, 10.9% was the average stock. They're at 3.5 points above that. That's excellent. And just keep working to keep that number elevated appropriately. What's your favorite, Ken?
The second place I look at a portfolio, and it depends, but it's either quality or it's sales growth, and I usually look at sales growth next. because you're not going to maintain a par that's acceptable for consistent long periods of time unless, my belief is, unless you have good, strong sales growth as a weighted average for the portfolio. And I fully believe in today's world, with dividend yields being relatively small, I fully believe that you need somewhere between 12 and 13% sales growth to achieve those goals of beating the market by 5 points.
Yeah, this used to be a much more widespread problem on the clubs we would visit, but it's gotten better in recent years. I think clubs have collectively recognized that they need to have an infusion of growth, an appropriate infusion of growth to set the table for success. And of course, we point to this slide all the time, not new to anybody that's been here before. These are the 20 most successful institutional funds out there over the last 10 years. Looking back 10 years, the column on the far right is the answer to the question, how much did they beat the market by over those 10 years per year? And the thing that we draw everybody's attention to is this reality of you got to have enough growth. And again, those are all ranging in the 12, 13, 14. They actually have dipped down a little bit. I would expect them to come back up as they continue to maintain those portfolios.
Well, and this club starts to feel real good about itself when Mark says, you're doing better than all but maybe about 15 or 16 of the funds that we follow in Manifest.
Good point.
That plus number that they had puts them right up there at number 15, 16, 17, somewhere in that general range, depending on the day and depending on what the market's doing. So it's you don't have to hit that 5 to feel really like you're doing a job that is superior to what most investors are doing, including the pros.
That's such a great point. I mean, when you think of yourself as 17th out of 650 funds, wow. All right. And of course, they had this question for us. I think I may have sugarcoated the question a tiny bit, but our explanation went from the cart on the side of the street selling hot dogs in Villa Park, Illinois, in the late 1960s to this guy owning that boat. In fact, it's not a boat anymore. That's a yacht. And the name of the yacht, Top Dog.
Top Dog. Okay.
Yeah, Kim, I think we should be invited on that yacht someday. So.
Well, I haven't seen it docked here, but I'll look for it.
Okay, watch for it. I mean, I've heard of it being near Naples and near Tampa, so it gets around.
Well, I'm sure they do, but I've seen Spielberg's boat here and a couple of others. So yeah, we get them.
Yeah, but Spielberg's can't come in, right? Doesn't it have to stay out on the ocean? It's huge.
Right near me there, right before you go into the intercoastal, there is Pier 66, and they have docks there before you have to go underneath the bridge. And yep, that's where he stays.
It's a monster boat. All right, keep going here. Another question from the club. Under the alert function, what exactly does the current date mean? We have explained it here, but again, just want to reinforce it. This data has been confusing to us. It's confusing to me, and we really do need to address this. We will with the next version that Kurt is currently working on now. The thing I wanted to again clarify is when we're talking about this particular date, the current date, it's referring to the last time that the company was fully audited, not necessarily updated. Audited meaning from left to right, making sure that everything is current and seemingly accurate. The fundamental data is updated pretty much continuously, and we use the following slide to illustrate that a little bit. You're actually peeking behind the scenes at Y charts, and the numbers on the left are the analyst estimates, and for some companies, these update daily. And you can see that in this case, you've got 10 or 11 analysts following Gentex with estimates ranging from 2025 to 2027, and that is what is continuously updating over here. In our data, producing these trends and those calculations. So they can float up and down. Obviously, they don't float up and down in a hugely material way, but they do float around a little bit, and it's something that we like to keep track of pretty carefully.
But it's important to make the point that we always make, Mark, as the number of analysts reduce, those dots have a lot more flexibility to float higher and lower because you're dealing with fewer and fewer people in the opinion pool. So the numbers for 26 don't move nearly as much as the numbers for 27, and it's simply because of the fact there's 10 analysts coming up with the 26 number and only 4 analysts coming up with the 27 number.
Yeah, and we will get into nasty situations where only 1 or 2 analysts are covering a company too, and then that can get extremely volatile. And then the other thing, which we have talked about in the past, we can talk about briefly. Nobody knew what to think of NVIDIA. You had estimates ranging from 20 to 80 for future earnings, and they're all over the map. 50 analysts covering the company, and they still can't put together a consensus forecast, believe it or not. So it wasn't that our algorithm was broken, it was that the inputs are just so turbulent, and for NVIDIA specifically. And we went through that, and it's maddening.
Mark, we're going to be studying in the Mid-Michigan Model Club infrastructure software, and that's companies like Microsoft, Synopsys, Adobe, Fortinet. And I was working on that this morning for a couple hours, and I'll tell you, even in that small sample of really pretty well-known companies, the differences between where Value Line thinks something might be going and where the manifest Y-charts data thinks it might be going are extraordinarily huge in some cases.
Yes.
So it's not just NVIDIA, it's a lot of the high-tech companies that have high growth numbers attached to them. I think that it poses a challenge for any data source to come up with a set of numbers, and then for those numbers to be consistent data source to data source to data source.
Yeah, I can find examples of companies where the price to fair value is 40%, and then you turn the page and the price to fair value from another source is 180. And I'm not making, those numbers are real, and it can be quite a thing. So this is actually an expansion of that. Go ahead.
Question from Ann Manning. If you can clarify what you mean by the company has been audited for the update date.
Just simply I go through it with a fine-tooth comb and make sure that the numbers I believe are. Think about when you have to figure out how to handle an SSG with a non-calendar fiscal year, and I think that will crystallize it for you. Figure out, well, what year is 2026 for this company? And what happens is some of the companies get confused because of how the analysts file their collective information. So I'm literally going through every single data point and making sure that it lines up with, within reason, our sources. Okay. And this is an example, just taking a quick look here. One of the things that, in fact, working with this club, we discovered is that when a company makes the jump from the Value Line Extended Edition into the Standard Edition coverage, a company like Excel Services, this will happen someday. They basically are using as reported data here, and then they'll make the jump into the Standard Edition. This will all be restated. And you can find several examples of that if you dig deep enough. So when we're looking at a company like this, we basically are using the non-GAAP data for these type of companies. These are I'm sorry, looked at the wrong direction. We're basically looking at these numbers. You can see there's a relatively small difference between these, but for some companies it gets quite major. So we're actually importing into our models. Again, we're looking for a representative model of the company for continuing operations. We're going to be using those top lines for the earnings.
Well, Mark, I think isn't it fair to say also that there's not very many instances of Y-charts being the outlier, but there are examples of Y-charts being the outlier in the data sets too.
Sure.
And when we find that happening, you will massage the data a little bit with using sources in addition to Y charts, so that we don't have Y charts kind of sticking out like a sore thumb, right?
Absolutely. And in the case of almost all companies, the line that is not impacted by all that we just said is the revenue. That's going to be, it's less adjusted. You want to think of it that way. So again, the answer to the question here, especially for companies in this realm, uh, being at the end of one edition and on the verge of the other, you do run into this situation. And I'll probably come back here within a few weeks with my war on earnings, but we'll leave that go for now. Before Ken dismisses me completely. And here was a look at one of their holdings, and you can see this company has come into its own. I think many of us own this company. It is one of our best small companies for this year. Pretty easy to draw a line through their revenues or sales and come up with a trend, and very credible representation of the company from our perspective. Good stuff. Anything else here, Ken?
No, I except to say that screens like this, they were asking us where we look for our favorite stocks, and Mark really likes this ivory soap screen based on the old commercial ivory soap, 99 and 44 100% pure. So he just uses the rank and puts in 99.44. I think the computer truncates it to 99, doesn't it?
They do.
Yeah, and
We do.
and here's what comes up.
It's Kirchstein.
It's a great screen for ideas, as long as you remember that it's an idea screen. It's not a buy screen. You don't have 16 buys staring in the face, but you do have 16 really good ideas that you can probably pare down to some buys if you do your homework.
And very often when I do this, I'll get a bogey, sort of like those things flying over the coast in New Jersey. And you got to take a closer look at them, and an audit will reveal some type of an anomaly, usually coming from the analyst, or sometimes the operator error. And I know who the operator is, so I know where to cast that blame. But it will unearth audit.
A gremlin running around the spreadsheet, right?
It can be that simple. So anyhow, this is my favorite way to find some stocks to study real quick. That's a pretty good list, fairly current.
I also think, Mark, it's a good way to audit how successful your portfolio is staying. When you pull up a screen that's this tight from a really huge database of probabilities, if you don't own 3 or 4 companies on this list, then maybe you have to ask yourself, are you really looking for the best of the best? Because that's what this screen is trying to show you. Well, I'm not saying you should own them all, but I think no matter when you run this screen, you should own 3 or 4 of them that come up.
Or at least be actively considering that. Because again, keep in mind that the answer to the question is, yeah, this is the numerical answer, but the real answer is, at Manifest Investing and at Better Investing, we believe in investing in excellent companies at the right price. So better companies at better prices, however you want to attach the words to it. The Manifest rank is nothing more than looking at the overall quality of the company on a percentile ranking basis in combination with the return forecast. You want a superior return forecast. So again, excellent companies in the buy zone or near the buy zone, however you want to think of it. This type of a screen should generate legitimate, reasonable companies for study. All right, let's go ahead and move on. This is a quick flash across the pan from Ben Carlson at A Wealth of Common Sense, and he's just pointing out that, yep, here we are, 10% into a correction. Corrections happen all the time, and there are periods in history when they cluster a little bit. He talks about that a little bit, but don't be surprised by this. Would be my way of thinking of it. And I do believe that maybe with St. Patrick's Day we've slain the correction. I shouldn't say that. No, forget I said that. That'll jinx us all.
Yes, it will.
Although we've had a couple good days, Ken.
Well, we're not having as good a day today, so watch it. Okay.
Oh, really? Okay. Here's our friend Tom Lee. I enjoy watching Tom Lee's work. He's one of Ken's boyfriends on CNBC, and we follow him fairly closely. And I hate this statistic and the way that financial planners present it, but I think I like it this way. And you can pick the top or the bottom. He's just simply making the point that if you're trying to time the market and you miss the 10 best days, if yesterday was one of the 10 best days in the last 3 years, I think it was yesterday or the day before, you leave those out, and I wasn't aware of the massive difference in the outcome. I didn't, I guess Peter Lynch told us this when he talked about his neighbors in his where he lived, his friends and neighbors around him actually achieving a negative return while he was generating a plus 13 at Fidelity Magellan. And this is how you do it. You attempt to time the market, sit out a few of those best days, and the next thing you know, you're having a really hard time keeping up. So why do we stay fully invested or very nearly fully invested? Your thoughts, Ken?
Well, I was going to put my quote in here from my friend at Schwab, who was quoted this morning as saying, "Panic is not a strategy. When you panic and move everything to cash," and I've heard people doing this. I even heard it talked about at my investment club meeting last night. Maybe we should sell everything, quote unquote. Now it was shouted down pretty nicely, but you can't panic. We're looking at long term, and we're trying to be calm, and we're trying to understand that volatility creates markets and creates opportunity for us to buy. And so you keep on doing what you're doing, and you keep doing it regularly, and you stay in the market. That doesn't mean that you can't raise a little bit of cash occasionally. Even Mr. Lee talks about raising some cash occasionally, so you have money to invest a little tiny bit more when things are really going badly in the market. You got some cash to deploy, but he's a very firm believer in long-term investing, and he's a firm believer that you have to stay in the market. You got to play if you're going to win.
Yeah, nobody knows when those days are coming. He does run an exchange-traded fund known as the GRNY shots, and the ticker is GRNY. And we talked last week about the 6 or 7 new additions to the portfolio. And here's just a quick look. I was kind of hoping and expecting to find some pattern here. The first 7 are the ones that they sold from the exchange traded fund, GRNY, and the bottom 7 are the most recent additions. They keep about 35 to 40 stocks in the portfolio, periodically doing, a sweep like this or a rebalancing. But I was kind of hoping to see, something obvious like high relative strength indexes at the top with low ones at the bottom. I don't see that. I do see that these value line return forecasts are pretty weak, and with the exception of this one, they're pretty good. But I'm not seeing a real strong pattern here. The one that he did actually make a big point on, apparently TransDigm lost a big customer, and their sales forecast for this year versus last year is an opportunity for improvement. And I don't know. You see anything here, Ken, that merits a deeper dive? I don't see it in the momentum.
Mark, if I cover the names of the companies and the symbols up, I can't really tell much difference between the stocks in the top group and the stocks in the bottom group.
No.
So it's obvious that he has very definite reasons why he's making the changes, but I can't fathom what they are based on this set of numbers. And I'm also answering a question that I know is being asked in some people's heads. The asterisk on MicroStrategy just means it's not in the main value line. That's all it means. It has no other meaning except it's not in the main value line. So don't give it any more value than that little tiny fact.
I can tell you though that that is one, again, they are notorious or famous, whatever word you or adjective you want to attach to it, but they're the ones loading up on cryptocurrency, Bitcoin in a big way as a corporate strategy. So this number here is Wall Street going gaga over that notion. And yeah, if Bitcoin takes off and goes, if it achieves orbit velocity or beyond, this company is going to be amazing. And so I do think this is a touch of speculation. You can see that it's got considerable momentum also, but uh, pretty hard to make a fundamental case for it.
Mark, our friend Sandy Castor has suggested, could it have anything to do with tariffs? I'm looking at CBRE, which is basically a real estate company, and I'm looking at Booking, which is a worldwide travel company. And I don't think tariffs are going to have much impact on either of those two companies. I can't speak to the rest of the group because I don't know where their supply chains are. But that might be entering into his thinking. It's as good an explanation as we can get by looking at the columns of numbers that we've collected here.
Yeah, the only thing I would add to that is, yeah, that could be a force, as part of it. The ones at the bottom are companies like Accenture and a few others that he thinks are very well positioned, going forward. And they basically have a strategy of they need to have, perhaps a leader in artificial intelligence combined with some type of a geographic advantage or something. They have to have a couple of key characteristics. PayPal is there because of uh, the evolution of currency going on and their role in that. So I I will continue to scratch my head over it, but we will be watching the performance of that portfolio and staying mindful to these as potential opportunities for further study. Again, think of it as a screen. I'm intrigued that he thinks Abbott Labs has a good outlook going forward.
Since
All
it's
right.
one of my oldest holdings, Mark, I'm intrigued with that also. So
Yeah, same here. I own that one also. All right, so this is an interesting topic that Kim has talked about for a while. You've heard her mention. Kim, what are you thinking about as you think about following an activist and looking for opportunities for ideas to study? How would you characterize it?
I did a class for better investing called spinoffs. A lot of times a spinoff stock is because an activist got involved. One of the most profitable for me has been when S&P Global was spun off, and I had presented it on the Manifest Roundtable. I think it was marked like at $89 in 2009 or something.
Yeah.
And blink, and we've gone a few years since 2009, and I think the last time I checked it, it had been over $500 a share.
Yeah.
So
unlocking value. Unlocking value.
Unlocking value, and the BI methodology is make money and get 15% of return a year and get that for 5 years and you double your money. Well, it seems that spinoffs can make you double your money in 3 years. And yes, there may be a little greed on my shoulder. So I have found that some spinoff stocks really do well, and I have been Bakul and I have talked extensively about this, and Elliott Management, as well as Janus Brothers, Janus Systems.
Yep, Janice. Yep.
Jana.
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 Partners.
Yeah, these two are great. How do you just say simply great at what they do? So if you can kind of see what's going on with them, I think it's just a cha-ching moment. And so I was, doing my reading and all, and this is where sometimes I get my ideas of spinoffs, because you can, there's a guy by the name of Joe Cornell, I believe, and he writes for, I think he writes for Fortune more. And he has a book called Spin-Off Stocks.
Mm-hmm.
And he is the leading authority on it. So sometimes when I'm looking for things, I look to see what's getting spun off and is this kind of a stock I want to do. And when you can get an activist involved to unlock value, and it's a company where they can do a lot of unlocking the value by making sure everything is much more asset light. Planes are expensive to have, but if they're able to do the backdoor things of just instituting a computer system that they're charging for luggage, you know, your suitcases, they have to get put on the plane and they get more revenue for it. That is asset light of what they're doing to make more money for the company.
All right. You're jumping ahead now, but okay. So this is actually a YouTube link. If you want to do a quick short course in the concept of activist investing generated ideas, you'll actually end up at that slide. Now, Bakul actually took and loaded that link into Notebook LM and generated the summary that you see on the left. That's the summary of the summary. And what? Go ahead, Ken.
Mark Bakula is with us today, and Kim, the name of that second group that does so well is Jana Partners.
Yeah.
Yeah, they've done some collaboration with Buffett and Berkshire Hathaway, I'm sure. So anyhow, Bakul, feel free to chime in. Again, he's looking for opportunities in companies which are underperforming, but are literally that turnaround target. Now, many of our investment clubs or people within the community have trouble with turnarounds, and turnarounds can be extremely challenging. But what we're talking about here is an individual becoming directly leveraged into the situation and highly knowledgeable about the operating characteristics and fundamentals of the company. And they're always perceived in the press as hostile. Many times they are not a hostile situation. Sometimes they become hostile, but it really is more of a, hey, have you thought about different approaches to your business type involvement? Here's a little more information that gives some background on Elliott and Paul Singer. And the thing that grabs our attention is that last sentence. What they have done has generated an appropriate advantage to the stock market. So good stuff. The chart on the right is from Insider Monkey, and it's some of their more recent positions, at least as of their last quarterly filing end of 2024, December 2024. The one we're going to talk about here for a little bit is this one right here, community favorite Southwest Airlines. Bakul and Kim have been kicking around some information on Southwest and a new development with Honeywell. But notice that he has a couple $2 billion invested directly into Southwest. And it's a very active situation going on right now. The other thing that just knocks me off my chair is, again, you're talking about positions at the end of December, perhaps some of them updated through mid-February, but those puts are literally bets against the stock market in various sectors of the stock market. I mean, just as a case in point, this is $4 billion bet against the S&P 500 at the end of the year. It's not a strategy that we deploy very often, but I suspect that these individual positions have worked out pretty well for Mr. Singer and Elliott here over the last few weeks, if they continue to hold them. But here's the one that we want to talk about just in a little bit more detail and a little bit of the type of context and understanding that we have. Southwest has been struggling. This is an article from Fortune a few months ago. I think that's Mr. Hogan. I don't know exactly who that is, but I think it is. And they just have been suffering. Here is a look at the stock price, monthly stock price ranges going back 10 years. And it's kind of the answer to the question, well, are we bandwagon jumping on something that's already left the station or the dock? I don't think so. I think it's still in a relatively low price position if a turnaround is possible. And that yellow area on the far right, I didn't do that highlighting, stock charts did, but I suspect that the positive price activity on the right-hand side of that is related to some of the activity and the stuff that's been going on at Southwest. Here, for more context, Hugh often puts up slides like this. Southwest for years was trouncing the airline industry, and that has changed a bit. So, Ken, is this where you insert your teenager comment, or?
I was listening to an analyst on the television talking about Southwest Airline and comparing it to a petulant late teen trying to become an adult but not wanting to give up some of the habits that it carried as a teenager. And they were speaking directly about the fact that they were going to start charging for luggage, and they were going to start boarding the plane in a different way, and they were going to start doing a lot of things like legacy airlines did. I thought it was kind of apropos after listening to the entire spiel and understanding the fact that Southwest is one of the largest airlines in existence now. It's no longer an upstart flying from a few airports. It's a major player in the industry.
Absolutely. I've used Southwest quite a bit personally. Here's a quick look at the company in the way that we would look at it. You see a company with a return forecast, not incredibly sexy, but near market levels, kind of in the mid-range of where they've been over the last several years, but you can see this noticeable deterioration. I'll use the word deterioration of quality. And this is a poster child for COVID. Ken points out in a number of his presentations the decline in some companies and the restoration. I think you can make a case for they have come out post-COVID and are back on a trajectory that makes some sense. But notice that the profitability did not restore to that previous level. I mean, here's your break for COVID here. The earnings are gone. So the question, scratching your head, what's going on here? What is actually happening, and why are they down there? What is possible? Here's a look at the company in a way I think, at least from a context perspective, this is probably how they're looking at it. Again, a projected return on value that's pretty close to the par. So we're looking at a decent return expectation, but here's COVID and here's coming back out of it. The question that I would have with the stuff that Elliott is doing with the company, they just landed 2 directors on the executive board at the company. They have a vision that somehow this can return and perhaps approach something between where they're at and these levels up here. And if they do that, you're looking at a fairly interesting opportunity. Now, it's an incredibly competitive industry, but where can they steer this thing and where can it end up is the question. And it's a good initiative to at least think through. And Ken, when we have done our club visits all over the place, we've generally found that the all male clubs are more willing to attack a turnaround situation.
And more actively staying with it also, even when the turnaround doesn't work out.
Oh yeah, stubborn.
Might say a little bit of stubbornness in there. Mark, if you could go back one slide, the one thing that bothers me more than anything else about this company is that I've really bought into this concept of quality. And when quality is declining, and it's already declining from a 50, I am ready to place this company on my own uninvestable list.
Sure.
I just can't figure out why I should spend the time studying a company like this with a quality that's in decline and it's moving down below 50. There's too many other opportunities out there for me to take a look at, and maybe the airline industry is not an industry that would interest me as a true growth long-term investor. It seems like you have to be pretty nimble to invest in the airlines, and you have to be able to jump in and jump out at different times, and that's too much work for me. So
Yeah.
I think that's the best chart of all, right there at the very top.
Yeah. And Warren Buffett a few years ago was, he basically stepped up to the confessional and admitted that I don't remember the exact airlines he chased, but he had a very poor experience, as in poor for the shareholders of Berkshire Hathaway. And it is a challenging deal. It's challenging anytime you get into a potential turnaround. But keep in mind that if they were able to boost those projected operating margins back anywhere near 20 again, just as a what if, the numbers do get potentially rewarding enough to go after. That's what these guys do. Not my style either. And I am notoriously bad at riding Walgreens all the way to the basement. So, yeah, it just happens.
Just one comment too. When you're thinking about this, and Ken, you are the biggest proponent of this of all, is to look at the industry, right? You want to buy the best, look at the industry, and your comments were along those. But this is happening alongside, for example, Spirit Airlines coming out of bankruptcy, and itself looking more like the other airlines than the, not quite like Southwest, but definitely cheapo that it was.
Yeah.
And that whole drama also has two other airlines, JetBlue and Frontier, wrapped up in it because they were potential partners or new owners. They really wanted the airplane fleet, I think, more than anything else from Spirit.
Mm-hmm.
So doubly hard for Southwest to change to be more normal looking when someone else is doing it too. And that's why I've always liked the lessors more than planes. So for some reason, airlines are romantic enough that they keep having people launching new ones or trying out the idea. But as you both said, they're notorious for getting into situations where they're not sustainable. And I think here the worry is that as the quality deteriorates, that could be the case for Southwest, because there's so much investment needed. You always need new airplanes. That it's not just that the new ones are better, but they wear out, literally. But people still like to fly, and more people in the world like to fly, and airplanes can be repositioned around the world. So the assets are quite valuable, but the endeavor to carve out a profitable niche, in particular by looking like everyone else, is really a tough one to swallow.
Yeah, it's going to be really tough on them. I would point out one other thing here. They do have $7 billion in long-term debt, but they also have almost $9 billion in their checkbook. So that is a consideration.
Yeah, Matt's right, Mark, that I really like to look at industries. And last night, the Mid-Michigan Model Club did an industry study on the defense contractors because we had a couple of members 2 or 3 months ago that suggested that the new president might be a real boon to defense contractors, and we should take a look at it. And for the first time in 4 or 5 years, we ended up with an industry study where the first vote and then all of the votes except 2 from the club came down to, we don't like any of the companies in this industry. And that's the value of looking at an entire industry. If you've picked one that for one reason or another doesn't have the characteristics that you normally invest in, it's okay to just reject the industry because there's so many other industries for you to take a look at. And I'm pretty sure that if I were to prepare an industry study for the airlines, at least the Mid-Michigan Model Club would give me the same vote that we got last night on the defense contractors.
You'd probably be physically ill by the time you were done, but that's a subject for another day. All right, so let's talk about Costco just for a minute. This was a question that came up last week, and Ken, they challenged our courage and manhood. Would we be really willing to challenge Costco in the roundtable portfolio here in the near future? It's a one-time selection that has gone up massively in the roundtable portfolio. And here's a look at the company. It's basically quality is still okay, but a little bit under pressure. The return forecast is typical or normal, whatever you want to call it. Sales have slowed, but not overly dramatic there. still up straight and parallel, just not as sloped. We're talking 6 or 8% here. And the profitability graphic at the bottom is pretty dramatic. This company is a machine. And the biggest question facing this machine these days is will they be able to stay on that green dotted line or not? And there's many people that don't believe that they will. And Ken, I did add the forecast sales profile from Better Investing. So you can always compare that number versus the slope of that red line, and you can see it's fairly typical.
From the member sentiment tab on the SSG Plus, yes.
Yeah.
I struggle, Mark, with managing this tracking portfolio because a lot of the things that I think should be done when you're managing a regular portfolio don't really apply to a tracking portfolio. In a regular portfolio, and I'm using a lot of examples from the Model Club, but last night we sold the remainder of our Costco position and then took that money, which was making a par. We had a par of, golly, within 0.2% of where your par is right there, Mark.
Mhm.
So our SSG was right on line with what you're calculating here with Y charts. And we sold the position in Costco, the remainder of it. We sold half of it the month before. And we put that money up into some of our smaller holdings that had par values above 15%. And we thought that that was the wisest thing to do. But in a tracking portfolio, you don't take the money that you might gain by freezing the position and put it back into the tracking portfolio in another way. So I struggle with whether or not we will make much of a difference by selling this position or not selling this position. I know it's had a massive increase, but it still doesn't represent that much of the entire portfolio.
Yeah, I can see where that gets a little bit tangled up, but again, you got to step into the trees and not back away from the forest, but actually dive into the forest on this single decision. The condition of this thing is down to the point where we're into mid single digits on the growth rate. So to my way of thinking, that begins to exempt it from the exemption. Is that a good way to say that? Of if you've got double-digit growth, you want to be really slow to sell. That's no longer true here anymore.
Absolutely, and the growth has slowed now. We used sales growth on our SSG of 8% going forward, and I see you using 8.5%. So we're definitely in the same ballpark. And we had made the decision 6 or 8 or 10 months ago to keep it. Even though the par had gone down below my par, and we kept it in the portfolio because the growth was up around 9.5%, 10.5%. But we think the growth has been very slowly but steadily, and you can see that on the sales line right there. That new trend line, if you're projecting into the future, does not have the same slope as the historical sales data shows. So we're getting a much slower sales growth, and we love this company. We were, I think we were going to have a mourning for the company because it was not in our portfolio anymore. But I think the portfolio needed what we did last night.
Well, to paraphrase Matt's question earlier, is Charlie Munger rolling in his grave? Yeah, so the other way to look at this is, with a very, very high quality company growing in double digits, you hold it until that return is basically, the return forecast is basically zero. And now you're at a point where you might relax that a little bit. In other words, not require 1165 as your selling point. So maybe somewhere in between. I don't know. I guess we are too stubborn and not manly enough, Ken. We'll see what the next time we have this debate at the roundtable.
And Mark, we were not comparing it to zero. We were comparing it to money market returns as well.
That's fair.
And money market returns are 4.5%, 5%.
Yep.
And a money market's a really safe investment compared to a compared to common stock, so there was a lot of grinding of teeth and everything else, but we try to operate without really voting. We try to operate as a committee of the whole when we're making our buying and selling decisions, and it works for us. Somebody in the audience, Robin, would like to know if we record and then let people listen to our meetings. No, Robin, I just don't think that we'd be eager to have those recordings out in the general public. You're invited to come to our meetings and listen to the chaos that goes on sometimes, but whether I want to hear it again a year later, I'm not sure.
Yeah, we're going to talk about that in a minute.
No, we don't do that, but we did finally pull the trigger on our Costco. We no longer own Costco.
Well, for me, I think it boils down to is that green line, dotted green line is going to be massively challenging. Will they actually be able to maintain it? I don't know. They just might. So good stuff. All right, here's a look at that.
Mark, we sold it only 3 days after our new Costco in Flint, Michigan finally opened. So
oh, you guys are heathens.
You got it.
All right, we're not going to go too deep into this other than to say we did make a substantial number of adjustments to this portfolio recently, including setting Luminar free to increase dramatically in price for Matt. Wouldn't have made a whole lot of difference here, but it was here. So anyhow, good stuff. A lot of strong performance from a number of the players here. We'll have more to say about Buttonwood in the near future.
Luminar might use that vocabulary of ballast, Mark. That's what it was in the portfolio. So.
And sometimes ballast is good. All right.
Yep.
Here's a reminder that we do archive all of these sessions, bull sessions, roundtables, and educational sessions on the Manifest Investing YouTube page. And Ken, you were just talking about how you don't want to go back necessarily and listen to discussions and decisions made years ago. I was
trying to figure out that racy slide right there, Mark. I wasn't quite sure what you were showing us. You mentioned that it was that body company. Okay.
The other day, recently, I was communicating with a regular attendee here and just pointed out that you can go to the YouTube channel, and if you enter that search, you will actually end up with the opportunity to listen to my presentation on Body Central from January 2013. And that is the now infamous presentation of how can a company go bankrupt with zero debt. But they did. And so you can go back if you want to insert hogs, a ticker symbol for Body Central, you can go and revisit that moment. But we were talking about how you could actually go back and listen to previous presentations on companies like Gentex or Adobe. You can actually do it there, and then if you locate the date, you can dive into the Manifest forum and actually look at the materials and maybe some of the discussions circulating, years ago. Not going to demonstrate it live, but go ahead and try that with one of the companies you might want to.
Well, it gives people the opportunity, Mark, when you decide to run for king of the world, that they can present what you said in history and ask why you said it. Okay.
Well, I don't know why politicians don't figure out that everything that they're saying they didn't say is actually recorded, but that's a subject for another day. And a couple of St. Patrick's Day entries, both of them from Barry Butler, a photographer in Chicago. There is the Chicago River, and then, of course, we had that wonderful moon last week, the blood moon, and Barry captured it appropriately, and I didn't have to get out of bed at 3 a.m. to see it, thanks to Barry. All right, I think that's all we had for today, Ken, unless you've got anything else kicking around. We did manage to get 39 of our 42 pounds into the bag.
I think we did a pretty good job, even with that 7-minute penalty at the beginning of the session, Mark. Okay.
Okay, we got to stop. Stop with that for sure. Good stuff. All right, so we will continue the discussion on activist investing, taking a look at the Honeywell opportunity next week. And then if anybody out there has any ideas or curiosities, let us know. Oh, we'll leave it with Ken and the sombrero for this month.
Okay, that's enough.
We do want to also make a pitch. If you're out there in an investment club and you would like to have a visit from your local chapter, reach out to your local chapter. If you have trouble doing that, you can contact either Matt or Ken or me or Kim, and we'll help make that connection in that case. And Ken and I would be interested in doing another one of these sessions. We don't want to get carried away, but we used to do dashboard diagnostic sessions on a regular basis. So if you're out there in an investment club and you would like to explore that, contact either one of us, and we'll explore that possibility also. So use the resources at your disposal. Our 2 email addresses are at the bottom of the screen if you have interest in any of that type of stuff. So thanks, Ken. And thanks all of
Thanks,
you
Mark.
for sharing your time with us.
This is always a lot of fun. Good afternoon, everybody.
Take care.